Hi everyone, welcome to my YouTube channel Fast and Curious, where we make you financially sound. In today's video, we are diving into two essential financial performance metrics: return on equity and return on capital employed. These indicators help investors and business owners assess a company's profitability and efficiency in using capital. So, financial performance metrics are essential for understanding a company's profitability. Two of the most important indicators, ROE and ROCE, help investors assess how efficiently a company uses capital. But what's the difference between them? Let's dive in. ROE and ROCE may seem similar, but they serve different purposes. ROE focuses on shareholder returns, how well a company uses equity capital to generate profit. ROCE considers both debt and equity, giving a broader view of a company's overall efficiency in using total capital. Understanding these metrics will help you make better investment decisions and evaluate a company's financial health more effectively. Stick around as we break them down in simple terms. So let's understand ROE. First up, ROE, return on equity. It is calculated as net profit divided by shareholders' equity into 100. ROE measures how effectively a company generates profits from shareholders' investments. A higher ROE means better efficiency. So let's see the pros and cons of using ROE. The pros of ROE are: it indicates shareholders' returns. It is useful for comparing companies in the same industry, helps evaluate management efficiency. However, the cons of ROE are: this ROE can be inflated by high debt, it ignores the cost of capital, and doesn't consider debt financing impact. So now let's take a look at return on capital employed, or ROCE. This metric tells us how efficiently a company uses its total capital, including debt and equity. ROCE is formula for ROCE is profit before tax divided by total capital into 100. ROCE is particularly useful for capital intensive industries like manufacturing and infrastructure. So, why ROCE is important? Because it shows efficiency in using both equity and debt. It is useful for capital intensive industries, and it highlights operational profitability before financing costs. The pros and cons of ROCE are as follows. Let's start with the pros. It considers total capital, good for capital intensive industries, and highlights operational efficiency. However, cons of ROCE, it can be misleading with capital structure changes, it ignores tax and financial costs. So, the key difference between ROE and ROCE are as follows. ROE measures shareholders' returns, ROCE measures total capital efficiency, ROCE neutralizes leverage impact, ROE can be inflated by debt. So let's understand a difference between ROE versus ROCE via a simple example. So for example, you have started a coffee shop. In this, you have invested rupees 10,000 and you have taken a loan from bank of rupees 10,000. And suppose the profit that you are generating from this coffee shop before paying any tax is rupees 5,000, and suppose you have paid a tax of rupees 2,000, therefore your profit after tax comes rupees 3,000. Now, how we are going to calculate ROE? ROE, like the formula, is profit after tax divided by your investment into 100. So here, taking this into example, like profit after tax is rupees 3000, your investment is rupees 10,000, therefore ROE is 30%. What does this mean? So for every 100 rupees that you have invested, the returns generated is rupees 30. Now let's see what are the applications of ROCE. ROCE, as the formula suggests, it's profit before tax divided by total capital. So here the profit before tax is rupees 5,000 and your total capital is your investment plus loan from bank, that is 20,000. So ROCE is coming as 25%, which means that for every 100 rupees capital, your business, the entire business, is generating rupees 25. So the key takeaway after explaining you the ROE and ROCE are, while ROE measures shareholder returns, ROCE evaluates how efficiently total capital is used. Both should be considered for a full financial picture. To sum up, ROE and ROCE are crucial tools for analyzing financial health. Always compare them within the industry, benchmarks and debt levels. If you found this video helpful, don't forget to like, share and subscribe. Drop your questions in the comments and I'll be happy to answer. Thank you.